For the most part, people hate insurance. Usually, it's just another monthly expense that you add to your list of bills, and when you eventually need it, they always seem to wriggle out of paying. But what if I was able to clue you in on a way to profit off of insurance companies? On your personal income sheet, this would turn them from an expense into an asset. If you're a savvy enough investor, then there is actually a way to profit off the price of insurance stocks going up by anticipating a rise in interest rates. If this sounds complicated, don't worry. I'm going to break down exactly what this means as well as how you can profit from it. So let's get right into it. But first, be sure to tap the like button below. This helps our video get ranked higher by the YouTube algorithm and will help other investors see this same valuable information. Thanks. Once you've done that, let's make you some cash. If there was ever a buzzword that financial people love to throw around, it's the term interest rate. Even if you don't follow along with the financial world, there's a good chance that you've overheard phrases like interest rates are low right now, or the Fed might be raising interest rates. It's almost like astrology, except that it's finance gurus always trying to predict what the almighty Federal Reserve is going to do with their interest rate. More importantly, what does any of this interest rate stuff ever mean? And most importantly, how does it impact you? Basically, the phrase interest rate usually refers to the federal funds rate, which is the amount that banks can lend money to each other for. This doesn't matter for you, though. All you need to know is that higher interest rates for banks will usually translate to higher interest rates for you. The interest rate that you're charged will depend on a lot of other factors, but it's mainly tied to the federal funds rate. This is important because you'll need to pay interest every single time that you apply for a loan. The higher the interest rate that you're charged, the more that you'll have to pay more in interest. On the other hand, the lower the interest rate that you're charged, the less you'll pay in interest. The interest rate has been uncommonly low during the past several years, mainly due to the COVID-19 pandemic. However, it's looking to be about that time that the Federal Reserve is starting to contemplate raising the interest rate. For most ordinary people, this is generally considered a bad thing. But for a savvy investor like yourself, it might actually be good. With that background info out of the way, let's get into the more important stuff. Mainly, let's answer the number one question that investors ask themselves. Now, for the sake of this video, we're going to assume that the interest rate is set to rise over the coming years. We can assume that this will be good for insurance companies, and allow me to explain. There has been strong evidence that shows that insurance companies become more profitable when interest rates are high. Now, if you want, you can even visit the trusted source, Investopedia, which is actually where I learned this information in the first place. On Investopedia, they state, historical analysis shows that the overall trend is for the insurance sector to increase profitability when there are rising interest rates. This is due to a couple of factors, but mainly it has to do with bonds. Insurance companies make money in two main ways. First, they make money by selling premiums to clients. However, most insurance companies don't count on this to earn them a whole lot of profit, and many expect to break even from doing this. The main way that insurance companies make their money is by investing their excess cash that they have. An insurance company sells you the premium and then just sits and collects money until it's time for them to pay a claim. Instead of letting this money sit idly, they invest it. When they invest it, they mainly buy bonds, since bonds are considered a very safe investment. Now, when interest rates go up, it means that the price of bonds that they own will go down. This is bad for all bonds that the insurance company is currently holding. But it will be good for bonds that they buy in the future because it means that they will make more money. To summarize quickly, higher interest rates mean that insurance companies will be able to make more money off of future bonds that they buy. This means that they'll be more profitable. Some of you are probably ahead of me by this point, but essentially, a more profitable insurance company should translate to a higher stock price. If the Federal Reserve continues to slowly raise its rates, it should mean that insurance companies become more and more profitable. This should mean that their share prices should slowly creep up. Another reason why higher interest rates should lead to more profitable insurance companies is because higher interest rates generally mean that the economy is growing. This usually translates to more car and home sales, which will ultimately mean more policies for insurers. As you can see, investing is always a game of trying to anticipate what's going to happen a few months to a year out. If you can do that consistently, then you'll be very successful. Now, let's get into the meat of the video and discuss a few stocks to consider buying before interest rates rise. Before we do that, be sure to subscribe below and hit that bell notification. That way, you'll be alerted every time that we have a new investing tip or strategy for you. Now, time to look at a few stocks that are best set to profit off a potential increase in the interest rate. Chubb. Since Chubb is the world's largest publicly traded property and casualty insurance company, they're one of the safest bets that you can make when buying an insurance stock. Chubb is one of the industry leaders in underwriting and most likely gained a decent chunk of market share during the pandemic. In 2020, they posted total revenue of $36 billion and a net income of $3.53 billion. They also have a divided yield of 1.78%. Chubb stock is up about 44% over the past 5 years and can be found on the New York Stock Exchange under the ticket MONEYCB. Next, we have Allstate. When it comes to finding an insurance company to invest in, Allstate is one of the best options. Allstate brings in very consistent profits and generally posts total revenue in the neighborhood of about $40 to $45 billion. Their total net income has also been increasing over recent years, and in 2020, they posted a net income of $5.58 billion. They also have a cushy 2.46% dividend yield. Allstate is one of the largest companies in the United States and ranked 79th on the 2019 Fortune 500 list of largest companies by revenue. There's a good chance that you recognize them from their slogan, "Are you in good hands?" Their stock is up 95% over the past 5 years and can be found on the New York Stock Exchange under the ticker MONEYALL. The third and final insurance stock to look at is MetLife. MetLife is the largest life insurer in the United States and also has tons of solutions for retirement. They're one of the largest companies in the U.S. and ranked 43rd on the Fortune 500 list of largest companies. In 2020, MetLife brought in a whopping $67 billion in revenue, along with a total net income of $5.41 billion. Out of the group, MetLife has the largest dividend yield and pays out 3.16%. MetLife stock is up 55% over the past 5 years and can be found on the New York Stock Exchange under the ticker MONEYMET. Obviously, there are more than just 3 insurance companies out there. However, these are the most well-established and will give you a good chance of profiting off a potential rise in interest rates with much lower downside risks. Feel free to take my theory and continue the research into other insurance stocks to see if there are any better options than what I listed. I hope that you found this video on the best insurance stocks to buy to be valuable to you. Let's go through a quick summary of everything that we've covered so far. First, the interest rate is the amount that banks are able to lend money to each other for. When this rate goes up, it's usually bad news for consumers like me and you because it makes it more expensive to get a loan. However, an increase in the interest rate is actually good for insurance companies. Second, insurance companies profit off a rise in interest rates in 2 ways. The first way is that a higher interest rate makes their investments in future bonds more profitable, which will mean more income. The second is that a higher interest rate usually means that the economy is doing well. When the economy is doing well, there will be more people buying homes and cars. These new homes and cars will need insurance, which means more premiums sold for insurance companies. Third, buying stock in insurance companies can allow you to profit if the stock prices of these companies increase along with interest rates. The earlier you can buy into these companies, the better chance you have to profit off an increase in their stock price. A few solid insurance companies to consider buying stock in are Chubb, Allstate, and MetLife. If you found this video valuable, please be sure to follow the very first link in the video description below and subscribe to my newsletter. By subscribing, you'll receive my most valuable tips for investing, any potential stock picks that I come across, and more informative content similar to what you've just watched. Most importantly, I don't believe in sending automated emails or spamming my subscribers. Instead, you can trust that each email that I send will be filled to the brim with valuable information that's sure to make you a better investor. Thank you so much for watching. I appreciate it, and we'll see you next time.